Hello, beautiful people, and thank you so much for joining us here on Great Day, Louisiana. I'm your host, Malik Mingo. I hope you're doing well today, and as always, we have a great show for you all today. We are starting with a conversation about taxes. Have you filed yet? You've got until April 15th to do so, but listen, there are some changes you need to know about this year before you file. So today, we're discussing those 3 changes. Joining me now is Gregory Ricks. He's the founder and CEO of Gregory Ricks & Associates. Welcome back, my good sir.
Hey, I'm so excited to be here today.
I'm so glad that you are here as well. Now listen, I've already filed my taxes, but for people who haven't yet, you definitely want to listen up. I gotta ask you this, why does the IRS make changes almost every single year?
Well, that's Congress. They're always looking for ways to increase taxes. Some adjustments are just built into law that there has to be adjustments each year, like for inflation, for example.
Absolutely.
Tax credits are being adjusted. So part of that is law. It's just always has been, always will be.
It's so true, but I have to say, researching on the changes this year, it really can help out a lot of people. Let's talk about this first change. It has to do with tax bracket adjustments. Talk to me about this change.
Well, that's because of inflation. We're feeling the impact of that, so they are adjusting the tax brackets. Now, each bracket's tax rate is not changing, but they're adjusting the brackets for inflation. So if your income stays the same, for example, you might see lower tax bracket.
And how does that help out somebody? Say they're in a lower tax bracket. Are the amount of taxes they're going to have to pay lower now since they're in a lower tax bracket? Like,
yes.
How does that benefit somebody?
Moving down tax brackets would be lower tax rates. Of course, on the other side, you could have some increase and stay in the same tax bracket. But moving up tax brackets will cost you more in taxes.
And that's so important that we're having this conversation because as somebody who works in the finance industry, it can be so difficult. Like, I didn't even know that there were changes this year. And like I said, I already filed my taxes. But the second adjustment is also something really interesting. An increased standard deduction. That has also been a change this year. Talk to me about this one.
For couples, the increase is to $27,700. For individuals, it's $13,850. 90% of the people use the standard deduction, so that does impact most people and give them a little bit more to deduct from their taxes. It's an important deduction.
Ooh, I like that. Now, like you mentioned, 90% of people do that increased standard deduction, but some taxpayers, they actually do itemized deductions. Like, what do we need to look at as filers to find out if we're going to take the increased standard deduction route or itemize our deductions?
If your deductions are going to be larger than that standard deduction, then you would use those itemized deductions. For most people, it's not. That's a large deduction to have. Now, if you do a lot of charitable giving or you do bunching, some years you might want to use the itemized deduction from that, but you almost have to have planning to do so.
And one thing you always suggest is not to just look at your taxes during the springtime like many of us are, but also throughout the whole year. But I want to talk about this third change as well. It has to do with tax credits. Talk to me about the tax credits.
There's a few tax credits, and this tax credits lower your tax bill through doing so. Earned income credit has increased to $7,430. Child credit is now, the first one is up to a family with 3 children.
The earned income tax credit.
Right, the earned income. Child tax credits are $2,000 per child.
Is that increased or is that the same?
I believe that's the same.
And that's per child?
Per child.
My goodness.
No, don't hold me to that. It might be an increase.
Right.
So we're looking at those as probably being adjusted up a little bit.
Okay.
Another one that's really popular is the EV credit, electric vehicles. It's, if you bought one in 2022 or 2023, it's $7,500 credit potential there for you.
So you get that money back. So if you paid a certain amount of money into your electric vehicle because of that tax credit, you're actually eligible to get up to $7,500 back?
Yeah. That's a pretty big deal. All those are great for, well, subject to you buying an electric car.
Right.
But the earned income credit and child credits impact a lot of people, a lot of families out there, and find it's tough raising children and paying for everything and food costing more. So those are all helping you. So don't overlook those details.
It's so true. Don't overlook anything, everybody, because we're dealing with our money here. You know, I alluded to it moments ago, but you really do suggest that people look at taxes as a year-long strategy, not just a springtime or wintertime strategy. Okay, talk to me about what we need to be thinking about throughout the year.
Well, part of it is getting efficiently into retirement plans. You know, like your 401k, that reduces your payroll, so it would be lower taxes. Deductible IRA contributions throughout the year. You need to plan for what's coming, but work towards it, not wait till last minute to make decisions. Just like right now, it's too late to put money into your 401k, but you can still put money into a tax-deductible IRA or add to your Roth IRA at this time.
And let's talk about that, because I've heard a lot of people talk about Roth IRAs and all of that. Why is that possibly a better route for people? Why doesn't everybody convert 401ks to Roth IRAs?
It's because there's a tax bite. They're going to pay a tax bill now for doing so. And you can't change your mind. Once you do a conversion, you're locked in and you have to do it. But it's always what bothers people is when it's tax time, like, oh my gosh, that's more than I expected. You should have planned for it. But it's one of those hacks. How do you beat the IRS? You know, let's give a quick example here. If you did conversions over 3 years to convert 100,000, and let's say in 3 years you'll be age 60, and let's say you average 7.2% return on your money, that 100,000, if you add no more, convert no more, would double to 200,000 in 10 years.
That sounds like more money to me, and that is a good thing for sure. Now look, Gregory, you know we can talk all hour long, but we got to take a break. If you need help with your finances, you can contact Gregory by visiting his website, GregoryRiggs.com. You can also give him a call using the number on your screen. He also has a radio show called Winning at Life from 10 to 1 on the iHeartRadio network on Saturdays.
Yes.
Check it out, everybody, and listen. Because we've had such a great conversation, Gregory is sticking around because we have more to talk about when it comes to taxes. What are some of the most common filing mistakes, and how do you avoid them? Stay tuned for that.